comes from Dominican Republic. We don't fly.
Wait. No. Please don't be fooled by this. In this video, I want to review the latest earnings from Napco. They just reported their earnings, so they have a different fiscal year, so that's the equivalent of Q2 2025, but just so you know, this is for the end of 2024. So that's the most recent data we have. And if you look at the stock price, how the stock reacted yesterday, well, yesterday the stock fell 26% in one day. That's a big jump. And to be completely transparent with you, I got interested in Napco after this big drop and opened a tiny position here, like maybe 1% or less of my portfolio, just to get a foot in the door, just to get interested, have some interest in the stock. And I'm glad that I didn't buy more. I'm glad I did. I just opened a tiny position, because if I just opened like a 5 or 10% position, I would have been completely destroyed yesterday. So yeah, the stock in pre-market is still down. Let me put your translation in English. And today we'll take our time. Take a glass of water, take a cup of tea, take some snacks, take some coffee, because I will review the earnings report here quickly, and we will listen together to the earnings call. So we will look at the transcript, and at the same time we will listen together to the call, what they have to say. And I don't know, I have just started listening to the call, and I don't know if I will buy more of this stock or not. Seems like the thesis is still intact, but we will see. I don't want to spoil you for the moment. Okay, so I think we can start. You have a clear picture of what is happening to the stock. This is a great company, small cap, that is being destroyed at the moment, and this is not the first time it happens. In 2023, the similar situation happened and the stock dropped 50% before rebounding sharply, and now the stock is down 50%. So we'll see. You flip a coin literally to see if the stock will rebound or not. So we'll talk about the financials, we will talk about the growth rate, we will talk about the capital allocation, and the goal is that you get some value out of this video. If you are a shareholder or if you plan to buy the stock, I will not recommend to buy or sell, but okay, let me, I have started enough time. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now and have achieved a performance of 25%. Not thanks to Napco, because I'm glad I didn't buy more of this stock. Okay, let's start. So they reported earnings yesterday, and let me check the report. Let me put full screen so you have a clear picture of what is happening. How can I zoom in? Like this. And if you don't know Napco, well, first, I don't know where you are. I don't know why you are watching this video. And they are in the security space, security industry. And they do hardware and software. Basically, if I scroll down and go to their income statement, you see two lines. They have the equipment revenue, so you have a hardware part of the business with a gross margin of 20%, and a service revenues, so that's the software side, recurring, high margin, 90% margin revenue. And historically, this service revenue has been going higher and higher, growing nicely, growing 40% per year, 30% per year, 20% per year. And now the growth for this segment has only been something like 10 or 15%. Let me check. Recurring service revenue here increased 14%. So yeah, that's a deceleration of the software side. Oh, how can I zoom in? I messed this up. Let me put full screen again. So first, what we can see from this report is a deceleration. Deceleration of the recurring revenue. And this was maybe the reason the stock dropped. No, I want to maybe download the, yeah, is that it? Perfect. That would be better. Let me zoom in. Okay, and if you decelerate the software side at the same time that your hardware side is weak, you have a collapse completely of your revenue. If you look at the equipment revenue, the hardware part of Napco, it's dropping like a rock. Like it went from $29 million last year to now $21 million. So that's a large drop. So if your big segment, hardware segment is dropping and the high margin segment is decelerating, well, you have a mess. You have a mess. And if you look at the total revenue for the business, they show this. For the net sales, like the total revenue aggregate overall is minus 10%. So that's quite bad. Quite bad if you compare this with other companies in the same space. So quite bad year over year. If you look at the gross profit, it's fairly stable. What is good is that because the high margin recurring software segment of Napco is decelerating but still growing, the aggregate, the overall margins are improving. So you have a gross profit margin going up from 52% to 57%. Yeah, and I believe this is expected to go to 60% or even more as the software part will become bigger and bigger and bigger. The gross margins will be higher and higher and higher. Pretty simple to understand. Now about the net income, I mean, let me go back to the income statement. That will be even better. They have some costs, more R&D, more infrastructure costs. And here we go, more SG&A, more costs, like 20% more costs. So business as usual. And that reduces your EBIT. They don't have much debt, so you don't have a lot of interest cost here. And overall, the net income for the company has been decreasing from $12 million to $10 million. Okay, that's a small drop. That's not the end of the world, come on. And if we didn't have this big drop in hardware revenue, the net income would be higher. And last quarter, the management said they would implement some buybacks. Apparently, they did some buybacks. If you go to the cash flow statement just over here, let me skim through it. You have some operations in the short term. You start from the net income. The net cash provided by operating activities is going higher. Okay, very well. They got some cash from accounts receivables. Okay, very well. They did almost no capex, as always. This is what I like also about this business. This is not a capital intensive business. You almost don't have any capex. So that's it. That's good. That generates a lot of free cash flow. And they used almost all the free cash flow to do buybacks. Here we go. So let me calculate the free cash flow. You have net cash provided by operating activities at $25 billion. Okay. You reduce the capex of $2 billion. So that amounts to approximately $23 billion of free cash flow in the quarter. Is that in the quarter? That's in 6 months. Okay, so in the latest 6 months. And they bought back $18 billion of shares. So most of the free cash flow is used to do buybacks. Okay, very well. Very well, very well. Now I have a doubt. And because the free cash flow, the free cash flow statement is using the 6 months, maybe I want to check the latest, the Q1 2025 report. See what we have here. Download here. Is that it? Yes. I want to compare the buyback program between both documents. That's 3 months. So for the Q1, so 3 months ago, they bought back $7 billion of shares. And they had the free cash flow of operating activities minus the capex. So that's $12 billion minus $1 billion, let's say this way. Last quarter, they generated $11 billion of free cash flow and bought back $7 billion of shares, $7 billion of shares. And in total, let me check. We said that for the 6 months, they generated $23 billion of free cash flow. Okay, so they generated 11 billion. So that's 12 for the latest quarter, 11 for this quarter. And for the buybacks, they bought back, where is it? $7 billion the latest quarter. And what was the number? 18. So they bought back 11%. $11 billion. So, oh, okay. Okay, sorry, I'm just thinking out loud. I'm just analyzing the report at the same time. Basically, in this quarter that was reporting yesterday, they produced $11 billion of free cash flow and they did buybacks of $11 billion. So 100% of the free cash flow is going into buybacks. So by definition, the management thinks the company is cheap at the moment. They are using all the buybacks to do dividends. Okay. What about the cash paid for to dividends? Yeah, they are using all the cash to do the buybacks. Some dividends for this quarter. Yeah, they are basically using all the excess cash, all the free cash flow to generate some strong shareholder returns, to reward the shareholders. And did they use some of their cash in their balance sheet to reward shareholders? I mean, come on. In the last quarter, what was the cash in their balance sheet? They had $55 billion of cash. Okay. $85 billion of cash. And now they have 85 billion. Okay, so they didn't function the cash pile in the balance sheet. So yeah, they produced some cash regardless of the growth decelerating, lower revenue. They generated some good cash flows and they used all the cash flow to do dividends and to do buybacks. Okay, very good. Now let me go through the report and you will explain you will understand why the stock is down. And I hope they will give more color on why the sales are down, why the hardware part is down. Okay, what do we have? Napco, in case you don't know, hey, let me read the definition. Napco, one of the leading manufacturers and designers of high-tech electronic security equipment, wireless communication devices for intrusion and fire alarm systems, and the related recurring service revenues, as well as a provider of school safety solutions. Okay, that's it, basically. And what do we have? Richard Soloway. Oh, by the way, the CEO has been selling some of its shares. You had some insider selling, which is not a very good sign, but still the CEO is a major shareholder of the company. So I would be curious to see if he continued to sell some of his shares during this quarter. Okay, as we complete the first half of 2025, again, the fiscal year is not at the same time as, I mean, we are in February and they already talk about the first half of 2025. Our performance has yielded mixed results here. The recurring part of the business increased 14% with the gross margin of, wow, 91%. That is good. That is very good, which was an improvement on last year. The recurring software high margin part represents half of the total revenue. Yeah, my guess is this part will increase. This percentage will increase. It will be 50% of the revenue and then 60%, 65%. It can grow substantially. Okay, for the gross margins improved. Well, they say what I've been saying to you. The reduction in our equipment revenue was a result of lagging sales in intrusion and access alarm products and door locking services, primarily as a result of reduced sales to two of our largest distributors, one of which we were informed made a corporate-wide decision to pull back on all purchases in an effort to reduce overall inventory levels. Oh wow, that's big. That's big. One of their biggest clients that bought a lot of hardware is going through restructuring and they basically stopped all the buys from Napco, completely slowed down on the inventory. Is it short-term or is it a long-term issue? If there is a restructuring, I'm guessing the new management of this distributor will assess if they will continue to buy Napco in the future, and maybe they will second guess Napco. Maybe instead of going with Napco, they will go with another security camera locks company. Oh, that is bad. That is quite bad. And a second distributor who is going through a management restructuring. I mean, that's the same one. Either you delay the inventory and you just postpone the inventory so you can basically pull off of the deal, and another distributor going through a complete restructuring. Okay, okay. So they say it's a problem independent of Napco. They couldn't do anything about this. Yep, but that is quite telling. If your biggest customers, distributors can just postpone the buys, that's quite bad. You are not really, I mean, this affects the moat in my opinion. It shows that you are not really a necessity. You are not the key leader. I mean, for any recurring business model, other hardware sectors, you don't see this. Okay, which we believe delayed the authorization to approve transactions and resulted in reduced purchases. Okay. In addition, the timing of new project work for custom locking products has resulted in reduced sales of locking devices through Q2 of fiscal 2025. New renovation. We were disappointed in our overall equipment sales, but we attribute the decline to timing and based on the historical purchase activity of our largest distributors. We anticipate improvement in equipment sale through the balance of fiscal 2025. So the fiscal 2025 will be the next 6 months. So they expect to recover in the next 6 months. How long is the restructuring for these two guys? I would love to. I would love that an analyst ask this kind of question in the call that we will see later. How long would it be? Do you have any color? Do you have any information on the timing on the recovery, the timing of the restructuring on these two guys? Because if they are in the big restructuring process, it can last for more than 1 year. That means the hardware revenue will be down for more than 1 year. And if the hardware revenue is down, it will drop, it will be a drag on total revenue. And this is expected to be a growth business. So if you don't have any growth in revenue, boom, you completely collapse your premium, your valuation, your PE ratio. Yeah, what is the business that, what is a good PE ratio for a business that doesn't grow? Like a PE ratio of 0. Maybe a PE ratio of 7, PE ratio of 10. So yeah, that's quite important for the restructuring. We continue to see growth in our school and classroom security sales, as evidenced by the recently announced contract with the Pasadena Unified School District. Okay, blah blah blah. Nothing has changed over there. I bought Napco just for your information. I bought Napco recently, not for the hardware part, but only for the software part of the business. So now I see that the hardware part is struggling for some temporary things, but I mean, this is management saying this. Maybe this is not true. And I would be also worried because of the deceleration on the software part. So I want to see more information about this. Okay, Prima by Napco is continuing to improve, I guess. Okay, nothing big. As we enter into the second half of 2025, we remain confident that our strong net income, adjusted EBITDA and cash flow will improve further. Yeah, every CEO will say this. Don't don't blindly follow them. As such, we are pleased to continue our dividend program. That's completely crazy. I mean, I don't like the way they are paying dividends at all. And we be paying the next quarterly dividends of this per share in April. As always, we will strive to accomplish our goal of continued financial strength, product innovation, technical superiority, and strong profitability for the body. Yeah, they have been saying this for years and years. I don't like the way they give dividends. If I look at the dividend history, let me give you some information. The dividends are quite new. Now that Napco has transformed itself into being a recurring high margin business, that's quite recent. And they are using all the excess cash to do dividends. They started the dividends in 2023, and look at this, the dividend has been increasing. Okay. As the stock, I mean, look at, this is the stock in 2023, right? And they opened the dividend, they created a dividend in May August 2023. What was the stock price in August 2023? Here, August, September, the stock was crashing, and I would have loved to see a huge buyback program here and not a dividend program at all. And the fact that the management seems to love dividends and increase the dividend payment is not good news for me. I mean, I don't like this at all. I would love that the management stops the dividend and just focuses on buybacks when the stock is cheap. This is exactly what FICO has done. And that's another great business. And FICO and Napco follow the same trend of shifting from normal margin business to very high recurring business. So we are in the same process, not at different stages of transformation. And FICO had been paying dividends for years and years. And in 2016-17, they completely stopped the dividends. They say it's not tax efficient. We want to reward long-term shareholders. So we will discontinue the dividend payment and we will just focus on buybacks when the stock is cheap. I would have preferred to see this for Napco by a lot. But the fact that, this is quite a bad capital allocation in my opinion. I would have loved to see this to drop, but anyway, that's bad. I would have loved to see them completely discontinue the dividends and double down on the buybacks. The board declared a new dividend. Okay. Very well. Okay. Well, now the business is still doing some buybacks. Don't get confused. As we just said at the beginning of this video, if you look at the cash flow statement for this business, look at this. Where is it? Cash paid for purchase of treasury shares. That's the buybacks. So still they are doing buybacks and paying the dividends. But come on, guys, you paid $5 billion of dividends. Just stop the dividends, stop the 5 billion buybacks, and put the 5 billion stop the 5 billion dividends and use the $5 billion to the buybacks. And they say if you want to reward long-term shareholders, please do this. Yeah, I don't like this. Maybe, this is not horrible because still they are doubling down on buybacks and this is quite good, but not perfect. If I look at the financials, by the way, cash flow statement, I want to check the repurchase of stocks. Let me check on FinChat what they have. On FinChat, you see that they didn't do any buybacks for years and years and years and years. And now they are big on buybacks. Maybe this chart is not very clear. Let me show you on another website. And I think after this we'll go to the earnings call. So take a glass of water. It will be long. Napco. I'm on Stock Unlock right now. You see me navigate through FinChat, Stock Unlock. If you want to test this, if you want to try these websites, you have discount codes in my description. And the cash flows, what can I check? The cash flows, yep. Cash flows, let's take issued. Okay. Look at this. Small buyback in 2007. 2007 was quite bad for Napco. You had a very bad acquisition, a write-off, and some deceleration in the hardware part. So that's a trifecta of bad net income, and they used some of the cash to do buybacks. Yeah, because they issued shares to do an acquisition in 2007. Okay, like a USA, another acquisition. Anyway, small buybacks here, big buybacks here. Like massive buybacks. That was for the last quarter, as we just saw before a few minutes ago. Last quarter, they bought back $7 billion of shares, and now they bought back $11 billion of shares. So you will see this chart. In a few days, it will be updated. You will see this chart going down again. So Seems like they time their buyback. So in some sense, I like it. Now you use most of your cash to do buybacks. But I mean, it's not terribly bad. They just give dividends for some reason, but I don't like this at all. But most of the cash is used for buybacks, so that's fine. Let me just check the free cash flow the cash flow statement. If I have some interesting things to say about the cash flow statement, if I see some interesting things, no, this is the interesting accounts receivables. Okay. Okay, very well. Policy, no income tax receivables, a little bit less. Purchase of marketable securities. Okay, so some of the cash that is on the balance sheet is used for marketable securities. They kind of have a portfolio in the balance sheet. No redemption of other investments. Would have loved to see what is that. Okay. And what do they have to say on the press release? Nothing. Nothing. In the balance sheet, what do we have? Now they have marketable securities. I think that... Oh, I think they have even more cash than this. A few minutes ago, we compared the cash balance on the balance sheet from the last quarter and this quarter. And we said 85 billion and 85 billion. But last quarter, they had like $85 billion. And now they have $85 billion of cash plus $15 billion of marketable securities. So now they have even more cash. Okay. I mean, all of this cash should go into buybacks. Come on. Maybe the company can even take some debt to do buybacks. I'm not sure. And look at this. The document is badly... The format of the document is bad. Is it just me? Investor presentation, report. Is it just me or the... Yeah, like the document is cut like this. The reporting is cut. And if I go to Napco earnings report, I will go to recent news. Let me check this. Oh, here we go. Oh, that was just FinChat. So if I look at the cash flow statement, the balance sheet, last year, oh, it was 6 months ago, they had this. No, that's fine. That's fine. Inventories, same thing. Nothing big. No, that's fine. Okay. No dividend payable. Yeah, what is funny is, I mean, this is a bit tricky for this kind of video. Maybe I will make a video about this. Last quarter, they paid a dividend, but last quarter, the dividend was not here in the cash flow statement. Like, it was not here. Dividends was not included here. But strangely enough, instead of putting a line in the cash flow statement, dividends, they put a line here in the balance sheet. Where is it? Dividends payable. A bit tricky. If you're not used to it, maybe you will be curious. But okay, you know what, let me not waste more of your time. It was just for the report. I don't see more value out of this report. This is a bad stuff. I want to see what happened with the two distributors. I want to see what is their buyback program. I want to see if they plan to increase their buyback program. If I remember correctly, they announced a plan to buy back, is it $1 billion or 1 million shares of buyback plan? I don't remember. I want to see if they plan to improve the buybacks. So a question from Wall Street analysts about buybacks would be great. I want to check their policy about dividends. I want to check their new Prima product, how it's working. I want to check the California fire. I don't think they will be impacted a lot. I want to check the school project, the security project for schools. But the most important part is the hardware part, the restructuring distributor. How long will it be before they recover? And what about the future growth rate for the service revenues? I mean, the service revenues, I can show you. Sorry, I'm just thinking out loud. This video is not very clear. Just this is the way I work. So let me download this. Oh, no. Let me show you this. Okay. Let me show you the slide. Oh, come on. No. Napco. Let me show you the growth rate of the recurring segment. This is this one. Okay. So if you look at this slide, they show you the growth of the software high margin recurring business. You see that this was a small part of the revenue in 2017, and then the revenue grows. If you look at here, this line, percentage of total revenue, a few years ago in 2017, this software part was only 10% of the revenue. And then it grows, it grows, it grows 20% of the revenue, it grows 30% of the revenue, it grows, and now it's already 50% because of the hardware part declining. So normalized, it should be like 40 to 50%. Okay, if you look at the growth rate for this software part, 50% growth rate, 40, 40, 40, 40, 30, and boom, we have a 14 now. So a clear deceleration of this segment. I want to see why. Is it linked to hardware? Anyway, where am I? Here, and
ladies and gentlemen, and welcome to the Napco
let's
Security
start.
Technologies fiscal second quarter 2025 earnings conference call. At this time, all lines are in listen only.
Okay, take a glass of water, take a glass of wine, take a glass of anything you want, and we'll be here for 55 minutes. I will speed things up like 1.5 times speed, so it will be a little bit faster than this, but I will have some comments along the way, I think. It's a little bit... Okay, this should be good. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
This call is being recorded on Monday, February 3rd, 2025. I would now like to turn the conference over to Francis Okoniewski, Vice President of Investor Relations. Please go ahead.
Thank you, Joanna. Good morning. This is Fran Okoniewski, Vice President of Investor Relations for Napco Security Technologies. Thank you all for joining today's conference call to discuss financial results for our fiscal second quarter 2025. By now, all of you should have had the opportunity to review our earnings press release.
Let me skip a little bit.
Our quarterly
Vice Presidents have
called to copy of the release. Kevin Buchel, President, Chief Operating Officer, and Chief benefits of our reoccurring revenue products to customers and dealers are proving to be incorrect could cause actual results to differ materially from a non-deal roadshow with Wells Fargo and other non-deal roadshow activity with us. Investor outreach is a vital part of Napco's strategy, and I'd like to extend my gratitude to everyone who contributes to the success of these events. With that out of the way, let me turn the call over to Dick Soloway, Chairman and CEO of Napco Security Technologies. Dick, the floor is yours.
Thank you, Fran. Good morning, everyone, and welcome to our conference call. We appreciate you joining us as we review our fiscal second quarter 2025 performance. This quarter yielded mixed results. Our recurring revenue increased by 15%, which generated a gross margin of 91% and led to a 400 basis point improvement in total gross margin to 57%. The reduction of equipment revenue was a result of timing issues with some of our distributors, as well as the timing of certain large locking projects. While certain revenue contributions shifted due to external dynamics, our core growth drivers remain intact, and demand for our products and services continues to build momentum. Importantly, our innovation pipeline is stronger than ever, with new offerings set to launch in the coming months, expanding our recurring revenue opportunities and reinforcing our long-term trajectory. As we move forward, we remain confident in our ability to drive sustainable growth and deliver lasting value to our shareholders. At Napco, our strategic focus is centered on capitalizing on key industry trends, including the expansion of wireless fire and intrusion alarms, the growth of recurring revenue services, advancements in school security solutions, enhancements in enterprise access control systems, and continued innovation in architectural locking products. We remain committed to delivering sustainable growth, maximizing profitability, and driving strong results on equity, all while maintaining disciplined cost management. These priorities are fundamental to our strategy and align with the best interests of our shareholders. I'll now turn the call over to our President, Chief Operating Officer, Chief Financial Officer, Kevin Buchel, who will provide an overview of our fiscal second quarter 2025 results. After Kevin's remarks, I'll return to discuss our strategies and outlook in more detail. Kevin, the floor is yours.
Okay.
Thank you, Dick. Good morning, everyone. Net sales for the quarter decreased 9.7% to $42.9 million. and that compares to $47.5 million for the same period 1 year ago. Net sales for the 6 months ended December 31, 2024, decreased 2.6% to $86.9 million, and that compares to $89.2 million for the same period 1 year ago. Recurring monthly service revenue continued its growth, increasing 15% in Q2 to $21.2 million, as compared to $18.5 million for the same period last year. Recurring monthly service revenue for the 6 months ended December 31, 2024, increased 18% to $42.3 million, as compared to $35.8 million last year. Our recurring service revenues now have a positive prospective annual run rate of approximately $86 million based on January 2025 recurring service revenues, and that compares to $85.
Let me check. Oh no, I have lost the slides. Oh, maybe I have here. They said a runway. Sorry, the recurring service, the high margin, the software part, revenues now have a positive annual return of $86 million. And in the slide from a couple of months ago, this was the reported recurring revenue. So from this, we jumped to $80 million. I mean, the growth for software is still here, so my investment thesis is still intact. Yeah, I mean, that gives me more confidence in the stock, strangely enough.
Million based on October 24 recurring service revenues, which we reported back in November. The increase in net service revenues was due to an increase in our cellular radio communication device activations, particularly fiber radios. We expect radio sales to continue to be a key contributor to our equipment sales and to lead to the continued growth of our highly profitable recurring service revenues. Equipment sales for the quarter decreased 25% to $21.7 million, as compared to $29 million last year. The decrease in net equipment sales was primarily attributable to reduced sales from two of the company's larger distributors, one of which, our largest customer, who purchases both intrusion and locking products, eliminated all quarter-end purchases from all manufacturers in order to reduce their inventory levels for their December 31 year-end. This distributor I spoke to personally, and he said, it's like an old Seinfeld line. He said, it's not you, it's us. So it's a decision they made, had nothing to do with our product. Our sell-through was good. It's a corporate decision they made. And the other one, there was another distributor who was going through a management restructuring, and that resulted in a significant reduction in their purchase. And in addition to the...
By the way, he mentions the old Seinfeld line from one of the distributor. He said, it's not you, it's us. I mean, this is not a love affair, a romantic situation. I mean, I'm old enough in this world to know that when my girlfriend said, it's not you, it's me, maybe it is not the case. Maybe it's a mismatch between the two people, between the two companies. So you never know if this is really true, actually. Strangely enough, they don't give a lot of information about the restructuring inventory. I want an analyst to ask this question. I mean, I want an analyst to ask a fierce question, actually, to move them and to get some information out of this situation.
In addition, the timing of project work related to a significant New York City building renovation for custom locking products resulted in reduced sales in locking in our Q2, as this project began in fiscal 2024 and it's winding down in fiscal 2025. Equipment sales for the 6 months decreased 16% to $44.6 million as compared to $53.4 million for the same period, and the decrease was primarily due to the aforementioned reasons I just mentioned. Gross profit for the 3 months ended December 31, 2024, decreased 2% to $24.4 million with a gross margin of 57%, as compared to $25 million with a gross margin of 53% for the same period last year.
Yeah, I mean, the gross margin is a beast.
The gross profit for the 6 months increased 4% to $49.1 million with a gross margin of 57%, as compared to $47.4 million with a gross margin of 53% a year ago. Gross profit for recurring service revenue for the quarter increased 16% to $19.4 million with a gross margin of 91%, and that compares to $16.7 million with a gross margin of 90% last year. And gross profit for recurring service revenues for the 6 months ended December 31, 2024, increased 20% to $38.6 million with a gross margin of 91%, and that compares to $32.2 million with a gross margin of 90% last year. Gross profit for equipment revenues in Q2 decreased by 39% to $5.1 million with a gross margin of 24%, as compared to $8.4 million with a gross margin of 29% last year. And gross profit for equipment revenues for the 6 months decreased 31% to $10.5 million with a gross margin of 24%, as compared to $15.2 million with a gross margin of 29% for the same period last year. The 400 basis point increase in overall gross margin is due to the continued very profitable recurring revenue. The decrease in gross...
Yeah, my guess is, I mean, you have, how can I show you? You have two parts of the segment, right? Two segments of the business. You have the hardware and the software. Boom. And you have low margin, oh wow, that's some bad writing, sorry. And you have something with the high margin. So in the past, it was like, what was it? The highest share of revenue they had was 35%, 40%. So usually the software is 40% of the revenue, hardware is 60%. So the software part is increasing the global margin. But because of their problem with the distributors, etc., the problem with inventory restructuring, the hardware part is dropping in revenue. And as a percentage basis, now the software part is half of the revenue. So it's normal that their share of the revenue increases. And if you compare this to the global gross margins, it's normal. So, I mean, they are saying here that the increase in gross margins is due to an improvement in the software side. Partly, but also partly because of the bad period for the hardware part. So yeah, maybe they will mention this, but this is just temporary. I wouldn't be surprised if the improvement in gross margins is diminishing in the second half of 2025 for their fiscal year. I wouldn't be surprised if they have stable gross margins for the next 2 quarters. This is not fantastic. This is just because you had a Lagarde segment. A Lagarde segment, okay.
Gross profit and gross margin from equipment sales for both the 3 and the 6 months ended December 31, 2024, is primarily the result of the aforementioned lower sales levels, as well as lower overhead absorption of fixed overhead costs from our Dominican Republic manufacturing facility.
Okay.
Research and development costs for the quarter increased 22% to $3.1 million or 7% of sales, and that compared to $2.5 million or 5% of sales for the same period a year ago. And research and development costs for the 6 months ended December 31, 2024 increased 24% to $6.2 million or 7.1% of sales, and that compares to $5 million or 6% of sales for the same period a year ago.
Okay, so costs are improving a little bit more. The percentage, I mean, that's fine. That's fine. They mentioned that as a percentage of sales, the R&D costs were 5% of global sales 1 year ago. Now these are 7% of sales. So you may panic, oh, what is happening? But it's normal. I mean, the global sales have been reduced. So that's not a red flag at all. Where am I here?
The increase in research and development for the 3 and the 6 months resulted primarily from annual compensation increases and the hiring of additional engineers.
Why do you need so many engineers? You build one product, one kind of product, some recurring parts. You don't need a lot of engineers to build this.
Selling, general, and administrative expenses for the quarter increased 18% to $10.2 million or 24% of net sales, and that compares to $8.7 million or 18% of net sales for the same period last year. SG&A expenses for the 6 months ended December 31, 2024 increased 17% to $19.9 million or 23% of net sales, and that compares to $17.1 million or 19% of sales for the same period last year.
Yeah, don't panic. All the costs are increasing as a percentage of sales. It's just because the sales are going down. So as a percentage, the proportion is increasing. It's not a red flag.
The increases in SG&A for the 3 and the 6 months was primarily due to compensation increases, the hiring of additional staff, increases in advertising and insurance costs, as partially offset by decreases in professional fees. Operating income for the quarter decreased 19% to $11.2 million as compared to $13.8 million for the same period last year. Operating income for the 6 months decreased 9% to $23 million as compared to $25.4 million for the same period last year. Interest and other income for the 3 months increased 26% to $921,000 as compared to $729,000 last year. And for the 6 months, increased 75% to $2.1 million compared to $1.2 million last year. The increases for both the 3 and the 6 months ended December 31, 2024 was primarily due to increased interest and dividend income from the company's cash and short-term investments as our net cash position continues to grow. The provision for income taxes for the 3 months decreased 16%, or $299,000, to $1.6 million with an effective tax rate of 13%, and that compares to $1.9 million with an effective rate of 13% last year. the decrease in the provision for taxes for the 3 months.
Yeah, what is funny is now we have seen the reports of some of the Magnificent Seven companies. If you look at Meta Platforms, for example, they had a lower tax rate for this quarter. A lot of companies had a lower tax rate now. And for Napco, they didn't have a lower tax rate. Maybe 13% is low enough, I don't know. They didn't benefit from a tax rate improvement year over year. That is also dragging their net income compared to other tech companies with the tax advantage.
This was primarily due to lower taxable income. For the 6 months, the provisions remained relatively constant, $3.4 million for both periods, this year and last year. The company's effective rate for income tax was 14% and 13% for the 6 months ended December 31, 2024 and 2023, respectively. The company's effective tax rate for the 6 months ended December 31, 2024 increased as a result of higher non-deductible stock-based comp. Net income for the quarter decreased 17% to $10.5 million, and that's 24% of net sales, or 28 cents per diluted share. And that compares to $12.6 million, or 27% of net sales, or 34 cents per diluted share for the same period last year. And net income for the 6 months decreased 6% to $21.7 million, or 25% of net sales, or 59 cents per diluted share. And that compares to $23.1 million, or 26% of sales, or 62 cents per diluted share for the same period last year. And adjusted EBITDA for the quarter decreased 19% to $12.2 million, 33 cents per share. And that compares to $15.1 million, or 41 cents per diluted share for the same period last year. And that equates to an EBITDA margin of 28%. And that compares to 32% last year. And the adjusted EBITDA for the 6 months decreased 12% to $24.7 million, or 67 cents per diluted share. And that compares to $28 million, or 76 cents per diluted share for the same period last year. And that equates to an adjusted EBITDA margin of 28% this year compared to 31% last year. Now moving on to the balance sheet. At December 31, 2024, the company had $99.2 million in cash and cash equivalents, other investments marked.
Yep, we saw $85 billion of cash and $15 billion in investments, marketable securities. I'm not sure what they mean by this, but I mean, for every company it's different, right?
Marketable securities, and that compares to $97.7 million as of June 30, 2024. It's a 2% increase, and that's even after paying $22.6 million in dividends and stock repurchases during this 6-month period. The company has no debt as of December 31, 2024. Cash provided by operating activities for the 3 months increased 80% to $13.5 million compared to $7.5 million last year. And for the 6 months increased 37% to $25.5 million, and that compares to $18.7 million for the same period last year. And working capital, as defined as current assets less current liabilities, was $143 million at December 31, 2024, and that compares with working capital of $146.5 million on June 30, 2024. And the current ratio, defined as current assets divided by current liabilities, 7.6 to 1 at both December 31, 2024 and June 30, 2024.
Yeah, I mean, the balance sheet is pristine. It's a 10 out of 10. They don't have any debt. They have a lot of cash. They don't have a lot of costs, so they don't have a lot of property, plant, equipment. This is an asset-light business model. They don't have much property, plant, equipment. They have a big facility in the Dominican Republic. They import parts from China, but the assembled parts are from Dominican Republic that they import, transfer to the US, and then they distribute to the US. So this is a nice satellite business model after all, and no debt, a lot of cash. This is good, very good.
And CapEx for the quarter was $1.1 million compared to $426,000 in the same period last year, and for the 6 months amounted to $1.8 million compared to $682,000 last year. This quarter's investment includes the addition of our second state-of-the-art Panasonic chip shooter machine, which is aimed at further improving our DR production efficiencies. That concludes my formal remarks, and I would like to return the call back to Dick.
Okay.
Thank you, Kevin. As we close out the first half of fiscal 2025, our performance has been a mix of challenges caused by timing issues and strengths.
I mean, come on, you've been attacked by a short seller, Fuzzy Panda. You've had a terrible problem with the hardware part in the short term. That's what you can call a mixed result or a fairly bad result. Oh, and it was a bad year for them. The software part is growing nicely. The hardware part is a mess, and you have been accused of fraud. You had to hire Deloitte as an independent auditor, and you have been selling personally some shares. That was a mixed bag.
While we experienced a decline in revenue, Napco continued to deliver solid profitability metrics and strong cash flow generation, further enhancing our balance sheet even after continuing our dividend program and opportunistic stock buyback, demonstrating the resilience of our business and the effectiveness of our operational strategies. Despite the decline in locking hardware caused by timing, we haven't lost sight of the significant opportunity for continued growth from spending driven by funded governmental infrastructure projects, as well as the millions of dollars going forward, state and federal level programs like Florida's School Hardening Act, Indiana's Secured School Safety Grant Program, and many other states like Texas that have approved hundreds of millions of dollars in increased security funds. Security in healthcare and retail loss prevention, as well as in multi-dwelling commercial and residential applications, are also providing opportunities for growth. We continue to remain focused on further penetrating each of these markets. A new growth opportunity in commercial locking and access control is our long-awaited MVP hosted access system, which could generate substantial hardware sales and recurring revenue for both the installing locking dealer and for Napco. This new innovative IP technology system enables wireless cloud access for end users of the system. Introduced initially at the International Security Conference in New York City back in November, we will once again be showcasing the new MVP system, along with many other new and exciting products, at the upcoming International Security Expo in Las Vegas, March 31 through April 4th at the Venetian Expo, where tens of thousands of security dealers will see it in action. We're excited about the potential of this technology for new installations, as well as retrofit or upgrade of existing locks with ease. We would ultimately drive increased equipment sales and recurring revenue from these products. Our recurring revenue growth today is driven by our Starlink radios, which alarm dealers value for their extensive coverage across both Verizon and AT&T networks. With rich feature capabilities, Starlink continues to be the preferred choice among our dealers. Our R&D team is continually enhancing these high-performance radios designed for straightforward installation and compatibility with all fire and burglar alarm panels, ours and our competitors alike. No other company can offer this level of versatility. Unlike our competitors, our radios...
I have a doubt. No other company can offer this level of versatility. Yeah, they have a one-stop shop. They have an equipment that is used for everything. So they have all the solutions in one basket of product for Napco. And this is maybe one of their key competitive advantage compared to other security companies that have one thing for something, and then another company has one thing for another problem. For Napco, you have all the bundle in one solution, and that is one of the moat. But how wide is the moat? Still not clear to me. Yeah, I don't know how long they can sustain this advantage. Where am I? Oh, here.
Is also Underwriter Laboratory certified, which is the gold standard in our industry.
Yep.
There are still millions of commercial buildings and residences, from offices and hospitals to schools, coffee shops, and restaurants, that need to transition from legacy copper phone lines to cellular connectivity. With Starlink, we're ideally positioned for continued strong growth in this market. Our latest Starlink Fire Max 2 communicator for commercial fire and alarm systems includes dual SIM technology, dynamically using either the Verizon or AT&T networks for optional signal strength. The streamlined solution, which dealers love, helps simplify their inventory while providing a feature-rich experience.
I mean, come on, let me accelerate a little bit, okay?
Our recent introduction of Prima by Napco, a new all-in-one panel for security installation and connected home with a 15-minute installation, remains a very important...
Because we already know this. I mean, if you are a shareholder of Napco, you know the drill.
...important focus for the company. Our goal is for Prima to address important mass segment of the security market, including residential and small business systems, with built-in Wi-Fi, cellular, radio communications, customer alert notifications, and video and smart home subscription options for each installed system. The security dealer, as well as the company, can add more recurring revenue, service revenue, generating accounts. Prima now offers a full set of necessary peripherals to go along with the Prima kit. We believe this will help enhance Prima sales in the future. While we were disappointed in our overall equipment sales, which we attribute to timing, our strong net income and cash flow indicates the continued financial strength of our business. As such, we are pleased to continue our dividend program with a payout of 12.5 cents per share. This will be payable on 4/3/2025 to shareholders of record on 3/12/2025. Also as announced last quarter, our board has authorized a share repurchase program, allowing us to strategically buy back Napco stock as market conditions warrant. As always, we will strive to accomplish our goal of continued financial strength, product innovation, technological superiority, and strong profitability for fiscal 2025 and beyond. I'd like to thank everyone for their support and for joining us in this exciting future we have.
Yeah, we learned nothing.
All more remarks are now concluded. We'd like to open the call for the Q&A session. Operator, please proceed.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press the star followed by the 1 on your touchtone phone. You will hear a prompt that your hand has been raised. Should you wish to decline from the polling process, please press star followed by the 2. And if you are using a speakerphone, please lift the handset before pressing any keys. The first question comes from Matt Somerville at D.A. Davidson. Please go ahead.
Thanks. Can you maybe comment on the number of device activations you saw this quarter relative to the prior quarter and maybe on a year-over-year basis, just trying to get a feel for with the lower hardware volume?
Yeah, they don't share this. The number of installations, they don't share this.
This quarter, how that impacted activations, and then I'll follow up.
Okay, so we don't disclose the pure number, Matt, but the number was greater by about 1,000 activations in December versus November, was greater by about 1,000 activations in December versus September, and was greater by about 1,000 in December versus June. So the activations, which we believe are going to get stronger, because as we've said, there's a delay. From the time you have strong radio sales, there's a delay because it's being sold to distribution, sitting on the distributor's shelf, then it gets activated by the dealer, then there's rebates, there's a delay. So we haven't seen the strength of last quarter, Q1, yet.
Yeah, apparently there is a strong rebate. I mean, if you install one of their hardware stuff, you get a delay, huge rebate, no price increases, huge discount. Apparently they are very aggressive with the way they sell hardware equipment. So they sell a lot of stuff and the clients don't pay a lot. And once the client has some switching costs, when the client is trapped with the product, they increase the price or they add more costs. Yeah, this is what I've seen on the internet, so I'm not sure about... Yeah, I mean, I agree with them with the delays and the rebate. Also, an additional thing is I have read some documents showing that this business lacks some pricing power. You would think that the software high margin recurring segment has some pricing power. They can increase the price of their software $10, $20, $14, $15, $20, $30, $40, but even I don't think this is the case. I thought about it and I don't think they have much pricing power because this has become a commodity. And from what I see, even this high margin recurring segment will become a commodity. I have no proof of this, but this is my sentiment at the moment, which is the reason I didn't go big and invested a lot in Napco, because I'm not sure about their moat. Still investigating.
With all that, the activations were still up by about 1,000. That's the best and the most I can tell you. That.
Well, that's helpful. I appreciate that. So with the recurring service revenue, we've seen deceleration now for 3 quarters in a row.
Yep.
I assume that this quarter's equipment sales imply at least another quarter of deceleration. What do you view as the more steady state growth rate for RSR, and when do we start to see that growth rate accelerate?
Just as a reminder, the high margin software part was growing 40%, 40%, 30%, and now, boom, we only grow by 14%.
So I think in Q3, quarter that we're now in, we'll see it come down a little more. We were up about 15% this quarter, year over year. I think that
I suppose there is a lag. They didn't sell a lot of hardware, so you need some time to implement the software.
That rate of increase will drop a little, maybe in the 12.5% range. Then in Q4, I think it goes up because by Q4, we'll feel the effects of the strong radio sales that we saw in Q1 last quarter. And it'll stay up for a bit, depending upon what happens in the upcoming quarter with radio sales. It can stay up the optimal rate, given that the number is much higher than it used to be. We think we should be able to grow this by 20%. At least that is without regard to Prima or MVP. That's separate, extra. I don't want to count that. It's got to prove itself. We think it will. But just with our radios that we're currently selling, we think it'll come back. It'll dip, and then it'll come back. 20% should be an optimal rate of increase.
I think this is also the reason why the stock is dropping. They basically said our growth for the software part is bad, only 14% is bad, and we expect the next quarter to be even worse. We will only grow 12%, and after this we will grow again 20%, but we are not sure. So a lot of uncertainty, and the markets don't like uncertainty. Yeah, maybe this is the reason. Hardware part, bad. Software part, bad. It will get worse, and we are not sure about the future. Oh boy, that's a lot of things that add up. Okay. Well, not sure of the... Because they don't disclose of a lot of information, it's hard to get a sense of will they go back to 20% growth. It's just guessing, and if you watch this video 1 year from now, maybe it will be funny because they will be able to grow again, or I don't know. But we have not a lot of information at the moment.
Okay.
Thank you. The next next question comes from Lance Vitanza at TD Cowen. Please go ahead.
Thanks, guys. A couple more things I wanted to ask you about, a couple more things that are probably beyond your control that could impact the numbers in the third quarter and the second half here. And those two things would be the fires in Los Angeles and Pasadena, number one, and then the tariffs or the tariff wars that seem to be going on right now. Just if you could discuss puts and takes from those two items, that'd be great. Thanks.
I can tell you on the tariff side, a lot of our competition gets product from China, and they get finished product. And all of our product comes from Dominican Republic. We don't fly.
Wait. No. Don't. Please don't be fooled by this. No. They say that some of the competitors buy finished products from China. I mean, the reports are here. This is completely public. Napco buys the parts of their products from China and Hong Kong, I think. A lot of them from China. Parts, okay? They do the assembly of these parts in Dominican Republic, where Napco has a factory. And then the finished product is sent from the Dominican Republic to the US. So they also deal with China. They don't buy finished products from China, but they take parts from China. Maybe, let me take 2 minutes. Maybe I will show you what I mean. How can I show you? This, open in a new tab. I want to check the annual report of the company. You will see what I mean. Annual report, the latest one, because maybe you are not aware of this. PDF. Let me click on, Let me click on PDF. And if I click on China, no, I don't know. China. Parts. I know there is Panda in here. Not here. Parts. There, I want a big table. Where is it? Oh, I don't know what to find here. Hong Kong. Where is it? I have found the information. Anyway, Fuzzy Panda is talking about this one. I had found it in an annual report or something like this. You know what? Let me Fuzzy Panda Napco. And great short report, by the way. And Fuzzy Panda research. Yes, this is a report. You can just type Fuzzy Panda Napco and you will find what they have to say. They are short sellers. So they bet against companies. They accuse frauds and they accused Napco of being fraudulent. So, if you are a bear or even if you are a bull and you want some bearish arguments, they do great work. And they mention a big table. Where is it? Here we go. The appendix, import-exports data confirms Napco locks come from China. Made in China for their locks segment. So yes, they import parts of their products from China. Napco locks business is made in China. They import from China. Look at this. Shanghai, Shenzhen, Shanghai. And there is one supplier's name that is called Panda. So they give a small heart here. So yeah, some of this business, I don't know the percentage of the parts. Not all the parts come from China, but they have some operations in China. That would be a good question. What is the percentage of their total parts that comes from China versus what is the proportion coming from China? I have no clear answer on this one. But for sure, they have some operations in China. So when they say, yeah, our competition is dealing with China and we don't, not true. Where am I?
Any components into the U.S. that all goes from around the world into the Dominican Republic, where it's assembled and it comes in as a finished alarm or a locking product. Competition, though, gets finished products. They make everything in China, most of it, both in the locking and also in the intrusion and access business. So I would expect that 10% is going to make us more competitive in the marketplace and help us win more market share because we have superior products.
Yeah, just for the sake of history, if you are watching this video in a few months, there have been some rumors of tariffs with Trump as a new US president. Mexico, Canada, China, Europe, everybody will get its fair share. Nobody is sure about the size of the tariffs, the percentage in which regions, but there are some strong rumors, if not facts, of Trump imposing 10% tariffs on a lot of Chinese products. This is the reason they talk about tariffs. And it's very likely that the tariffs will be here for a long time. I mean, for China, I think you will have like a trade war or something like this. We are currently watching this with Mexico and Canada, so still in discussions. The tariffs have been postponed for 1 month over border issues. For China and Europe, it will also be the case. So this is the reason why they talk about tariffs, okay?
With the superior pricing, the dealers are price sensitive. That should really help us pick up a lot of share. There was some scuttlebutt about Mexico, and I understand they rolled that back this morning for 30 days. Some of our major competitors in the intrusion and firewall business make their products in Mexico, all their products in Mexico. So there'll be some settlement, but you can be sure that there's going to be tariffs to those Mexican products, which is going to give us ability to also pick up share with dealers because they're cost sensitive. And in Canada, we have some competition also that makes their control panels up there. So that's going to be kind of like the Mexican situation where there's going to be tariffs. So all in all, it should be a benefit for us. The dealers have to keep their installers and salesmen working. So they're going to be going out and keep soliciting jobs, and they're going to need merchandise for that. And the owners of those companies are going to say, let's try the Napco products. I've heard a lot of great things about it. And now that the price is so much less expensive, it helps my margins in my business. And that's going to be something that our salesmen are going to be looking to do, bring in all kinds of new market share, new customers in all of our different divisions of locking, access control, and fire and burglar alarms. So that's the situation on that. When it comes to the California fires, there's going to be rebuilding. It's going to be slower. A lot of it was residential. And as I said, most of our business in the recurring revenue business is commercial buildings. So we would expect that the dealers are going to be putting in more and more fire alarm systems, more and more protection systems, sprinkler systems with fire communicators. When the sprinkler head goes off, the communicator will call the fire department. And I hope we're going to have plenty of water out there. But it's a terrible tragedy what happened. So that's how we look at the situation.
And Lance, we did do Pasadena School District, and we also announced Pepperdine. So Pepperdine is right across the street from where all this action is, and Pepperdine's going to be doing a lot of dorm work. And what we had heard is the kids were out of the school for a little bit. I think they're back now. We expect these projects to continue as we go forward.
Very good. Thanks, guys.
Thanks, Lance.
Thank you. The next question comes from Jim Ricchiuti at Needham Company. Please go ahead.
Hi, thank you. I had to jump off momentarily, so apologies if you gave this already, Kevin, and I missed it. But did you provide the breakdown of equipment revenue? It's going to be in the 10Q later.
Yeah, I can provide it. It will be in the Q, which will be out shortly. But the intrusion and access for the quarter was $7.6 million. The locking was $14.2 million, and the rest was the recurring, which was $21.2 million.
Okay, so there is a split between the hardware and the software. Software was $20 million, hardware was $20 million, partly access, intrusion and access, and that was 1/3 of the hardware, and 2/3 of the hardware are locking. So 2/3 of the hardware will deal with China parts. So you will have some effects.
Thank you. And it sounds like the shortfall was mainly due to one distributor and to a lesser extent a second distributor. The question I have is, how much variability are you seeing in the sell-through among your various distributors? Meaning, is this specifically related to one distributor that's you've noted wants to bring down inventory levels, or is there any sign that you're hearing from them about a change in demand, and whether it's uncertainty just given the economic impact of some of the things we've been hearing about?
Yeah, this distributor is nothing to do with us. So if I look at their sell-through stats, their inventory levels, that's not why they decided not to buy this quarter. As I said earlier in the prepared remarks, this is about them, not about us. So, and I've had conversations with them since. Now we're in the new quarter. They expect to be business as usual with us and with others. For whatever the reason, the big conglomerate, they made a corporate decision. Maybe they're doing an acquisition. Who knows why? They made the decision they made. They're very happy with our products. They buy all our products. They buy the Napco intrusion. They buy the alarm lock locks. They buy the Marks locks. Super happy with us. And the reason they're happy is because the demand from the locking and the alarm deal is strong. That's where the sales really ultimately come from. If that demand is strong, their sales will be strong. So they made a decision for their year end, December 31, and this happens every now and then with distribution.
So we have no information. No information about the timing of the restructuring. Oh, I don't like this. I don't like this.
And the last question for me is just on the topic of operating expense, just in light of the slower demand that you've seen. Are you making any adjustments to OpEx? I know you've got the big trade show coming up, and obviously you're going to be investing in that, but just any thoughts around OpEx going forward?
No, OpEx we'll keep doing what we're doing. Nothing that happened in this quarter affects our operation. It's all like we've been saying, timing. So we forge ahead. We think we have the right levels of salespeople and engineers, but if we need more, we add. We've added several engineers over the last 12 months. We used to say we have 50, 55 engineers. We have probably over 70 now. What we're trying to do, get products to market faster. A lot of the products have recurring. We want to get them out in the marketplace sooner. If that means adding some engineers here and there, we can afford it. Our profitability, our cash flow, it's not an issue for us.
Thank you.
Thank you. Ladies and gentlemen, as a reminder, should you have any questions, please press star one. The next question comes from Jeremy Hamlin at Craig-Hallum. Please go ahead.
Thanks for taking the question. And I wanted to take a step back and ask more of a high-level question. You've talked about kind of the push in 2026 towards a goal to get to a 50-50 split on your equipment versus your recurring service revenues, in driving that business really to kind of $300 million total revenues, which would imply 150 in the RSR.
Yep, they mentioned this big boy. They mentioned that in the long term, the plan for Napco is to generate 50% of the revenue coming from the software, and that should amount to $150 million. For the sake of the exercise, a few minutes ago, they said now it's not 150 million, but currently it's $86 million. So they are halfway through, but when it comes to the split in revenue, you're getting there.
Seems like that's not likely a goal that can be achieved from kind of current levels, but wanted to get a sense for if you could maybe reframe for us, where you think you could, bounce back here, and how we should be looking at the business. Given that this is kind of the second straight quarter in which you've had adjusted EBITDA margins in the 28% range, and kind of with that target that you'd laid out before, you've been talking about maybe getting adjusted EBITDA margins up towards 40% plus. And I know that's still, I'm sure, the long-term goal, but wanted to sense for what's a bit more kind of visibility on where you are with the business today.
Right. So our goal.
That's a good question. I hate the adjusted EBITDA mention. You can basically cheat on all the adjusted EBITDA margins, but that's a very good question.
Is to get the EBITDA margin in the mid-40s, and when we were at 32, we were on our way to it. So now we've taken a step back. We're 28. Still a very strong EBITDA margin, but not our goal. We'll hit our goal. We need a few things to happen. We need the recurring to continue to grow. I wanted to see it grow in the 20% range, as I said earlier. When we originally created the goal, the 150 to 45% EBITDA target, the margin that we used was 80%, because that's what it was at the beginning of this recurring revenue journey. Now it's 91%. And you could go higher? Yeah, it could. But at 90% and grow it by 20% a year, that's step one. Step two, we need the equipment 10% increase. Not what we saw this quarter, not what we saw last quarter. We need about 10%. We don't need anything more dramatic than that, but we need 10. And we don't need, because originally we had margins much higher on the equipment than they're running now. They need to be in the 30s. If we could get that, grow by 10%, margins in the 30s, get the recurring to grow 20%, 90% margin, and keep your OpEx reasonable, grow it by maybe 10% more per year, then we'll be in the 40s. So I don't know if we'll get there exactly. The original target was the end of 26, call it a year and a half from now, but we'll get there. And we want to show that we're well back to being on our way towards that goal. And the next couple of quarters, I think, will give that confidence.
Yeah, not sure at all. It's true that when they did the forecast, they forecasted that the recurring high margin software part was going to have a gross margin of 80%. And now for a few quarters, it's 90% margins. And it's true. I mean, you have a competitor, alarm.com, that focuses on this recurring segment. And they also have 90% margins. So it's doable. They can continue to grow the software part with a 90% margin. They expect to grow 20%. So be it. That will be wonderful. For the hardware part, they have been struggling for a long time in their hardware part. For the hardware part, the margins were okay. And now as the business is getting more commoditized, more competition, more costs, the margins of the hardware segment the margins are going down. And the growth rate is going down. So I don't think that's achievable. Maybe, I hope I'm wrong, but for the hardware part, I have a strong doubt. For the software part, yeah, that could be done. They can sustain these high margins and grow nicely. For the hardware equipment part, I don't know at all. Yeah, I don't know.
Let me ask a follow-up question related to the equipment revenue. So, to kind of reach these goals, you had, kind of high 20s in terms of where your equipment revenue run rates had been, and that was yielding, nice growth on your service revenues. In terms of pushing forward to get those gross margins on your equipment revenues above 30%, in kind of vis-a-vis, getting your total company EBITDA margins at least to the mid-30s, let's say, as a starting point, what's the absolute dollar sales that you need or revenues that you need on an equipment, perspective per quarter or on an annualized basis to think that those are reasonable targets to get those the gross margins for the equipment back up to 30% plus, so that you can really push forward here on total company EBITDA margin?
I would say a $30 million hardware is the bare minimum of what we want. Not unreasonable. Last year, for 3 out of the 4 quarters, that's kind of where we were, a little below that. The margins really grow when you get more sales flowing through your offshore factory. Our Dominican factory, the more volume we push through it, the better the margins are. We've shown this in the past, because when we get busy, we just have to add more direct labor. That's the lowest piece of the cost structure. We have a facility that can handle it. We have machinery that can handle it. We just bought another Panasonic chip shooter machine, which will give us even more efficiency, to get us even better margins. So you need that volume. And as long as the mix is reasonable, you get there. Locking has to be a key part of the mix. It's been that way. Locking has margins in the 35 to 40% range. We don't care so much about the radio margins, the hardware. It's all about the recurring. So as long as the mix is reasonable, the volume is in the 30 plus, we could be in the 30s. We proved it in the past. It just happens. Just add more direct labor, nothing else. More overhead absorption, margins expand. So we got to have that.
Great. Thanks for taking the question and good luck.
Thanks, Jeremy.
Thank you. The next question comes from Jason Schmidt at Lake Street. Please go ahead.
Hey guys, thanks for taking my questions. Just curious if you can update us on how the ADI relationship is progressing and if it's progressing to plan.
ADI doing well, introducing us to more and more dealers as we've talked about in the past. They made an intro for us to Securitas, who now buys our fire radios. We had said, maybe it was the last call, I'm not sure, we thought ADI could be a 10% of equipment sales customer. That's our hope. Their sell-through stats are good. If that keeps up, that could happen. So very happy with the relationship, and we have more work to do. The potential is very good with these guys.
Gotcha. And then just as a follow-up, just given how December played out and kind of how Q3 here is tracking, would you still expect sort of normal seasonal patterns for equipment revenue in June?
I would. If you go back to the history books of this company, Q4 is always the strongest. You never know with distribution. You never know with things that are unforeseen. But statistically, I would expect it to be the best. A lot of our big customers, big distributors, their year end is December. So they don't usually make decisions like we just saw in June quarter. And for us, the June quarter is important. We want to maximize our sales. So typically, it's the best. We expect it to be the best. We expect Q3 to be a comeback quarter versus what we just saw. And whatever it is, we expect Q4 to be even better than that.
Okay, perfect. Thanks a lot, guys.
Thanks, Jason.
Thank you, ladies and gentlemen. As a reminder, please press star 1 if you have any questions.
Well, let me check. Let me check their quarterly growth. They said their June quarter is usually the best. Let me see the spikes here. Spike here in June. Spike here in June. Up in June. Up in June. So kind of true. June. 06 there. Yeah, okay. So that's true. What they say is true. Fact checking live.
Follow up from Matt Somerville at D.A. Davidson. Please go ahead.
Thanks. I just want to be clear. Equipment revenue, should we expect that to grow on a year-on-year basis in Q3? I mean, logically, if this was a one-time, this is us, not you type thing,
come on,
why wouldn't we start to see year-on-year growth in Q3, again, in hardware?
Q3, like Q2 and Q1, had a very large amount of sales last year from this large New York City project that we've talked about. And so it's a special project. And it's not going to be as large this year in Q3 as it was last year. That's not to say there won't be a special project or two in this quarter, but I can't say that as I sit here today. Without that, the comparison is difficult. So if we did close to 30 million last year, we'll have a tough comp because of this special project that we saw last year.
Okay, so they will miss on the revenue next quarter. Basically, they will fail on the equipment. I suppose this is also the reason why the stock is dropping. Wow, that's a lot of misses.
So even if the distributor comes back, and we're pretty sure he will, and we think the other distributor as well, it'll significantly put us beyond what we just saw in Q2. But to hit 30 million, I can't say for sure. A lot depends on special projects, which we might get. But that's why there's a little hesitation.
And then just lastly, share repurchases, given what's happening with the stock today, are you thinking about more aggressive repos? You're sitting on $100 million. What's the right way to kind of think about that?
Well, we like to do this opportunistically. This could be a nice opportunity based on what the stock is doing. We like having a lot of cash, and for moments like this where we could use some of it.
Yeah, I mean, in 2007, 2008, they needed the cash badly. So maybe this is the reason why they are so secure, how do you say it, conservative with the cash. I mean, 2007-8, they were hit badly by the great financial crisis. Commercial buildings, I mean, that was a mess. So they had to take some debt. They had to issue some shares. So yeah, I kind of understand why they are being conservative. We are not in a great financial crisis, but you never know. Second question, what is the cash cushion you should need? Is it 100 million that has to be on the balance sheet at all times, or is it $50 million? So can you use some of the cash to do more buybacks? I don't know.
We still are looking at acquisitions. Has to be the right one, but that's part of what we do.
Oh, come on, please don't do an acquisition. Come on, no, please.
A lot of banks trying to find the right deal for us. We don't want to do a deal unless it's the right one. We're not going to rush into anything. We feel our business is strong just the way it is, but there could be a deal out there. We keep looking, and it'd be nice to have cash for that too. So we try to balance it. Buybacks, the right acquisition, the dividends, and keeping cash on hand, all the above. So stock buybacks is in the equation.
I don't like the answer. I mean, come on, acquisitions, when the stock is dropping like a rock, when you are accused of being a fraud, you have to show strong results, show that you hired Deloitte as an auditor. I mean, they don't mention the Fuzzy Panda report at all, and all the implementation they've been doing. Oh no, I would have loved to say, yeah, we will be opportunistic with our buybacks. And if we dry up our buyback program, we have the means to increase it and to continue the buyback program. So wait and see, guy. But I would love to have them say, we used most of the free cash flow this quarter to do buybacks. You know what it means. And if we have to complete our buyback program, we are in the right position to create an additional buyback program, because we think the stock is undervalued at the moment. We see the stock repurchases as the best alternative at the moment. Some companies do this. I mean, I mentioned Fair Isaac, FICO before. This is exactly what they say, and they do it. So it's doable. It's not it's not something extraordinary to say. It's just some change in different mindset, I guess.
Got it. That's it, really. Thank you.
Thanks, Matt.
Thank you. That concludes our Q&A. I will turn the call back over to Richard Soloway for closing comments.
Thank you, everyone, for participating in today's conference call. As always, if you do have any further questions, feel free to call Fran, Kevin, or myself for further information. We thank you for your...
It's thank you and bye-bye. Okay, anyway, mixed view of this earnings call. Frankly, you had some comments on the distributors, but not a lot of information. They say that the distributors will come back, but we don't really have information about the timing. Maybe next quarter, maybe not. They expect the hardware to continue, but I don't believe this. They expect the software part to continue to grow. They expect the next quarter to be bad for software, to only grow 12% and then grow back to 20%. Not sure of this. For the buybacks, I mean, they mentioned acquisitions. Come on. No, they could. I mean, I would have loved to see other stuff, other elements of response. Not really convinced by this report. I will keep you guys updated if I buy more of Napco. I don't think I will. The next question is, will I hold my Napco or will I sell? I need to do more research. I will maybe reconsider, but this is why I just opened the 1% position. To have this choice, my portfolio will not be impacted if I fail. It's just an investigating position. So that's it. I mean, now you know a lot about this report from Napco. I hope it was useful. Don't forget to leave a like, to subscribe if you want more videos like this, to comment below in case I'm wrong in this video, because I'm a recent shareholder. Maybe you guys know more than me. So if I make a mistake, if I say something wrong, I'm biased, obviously. Comment below and say when I'm wrong. I would love to learn more about this company. So I'm sure some of you guys know more about Napco. That's it for today, guys. I wish you a nice rest of your day. Bye-bye. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.